VGFC announced its Q3 result this Wednesday. Don't look at this, as management is sugarcoating the earning by comparing year-to-date result with the same period last year, meaning the period from Q1 to Q3. In this video, we are going to compare Q3 result with last quarter and Q3 last year, and answer a few questions in the comment section. Mr.Alpaca Business Updates. Let's first start with revenue. It turned out that the Q3 revenue was very close to my previous bearish projection. E-commerce grew by only 58% year-over-year, but declined by 30% quarter-on-quarter. Wholesales grew by 173% year-over-year and 86% quarter-on-quarter. Butcher shop and restaurant grew by 69% year-over-year and 20% quarter-on-quarter. The overall revenue grew by 85% year-over-year, but declined by 9% quarter-on-quarter. Let's applaud for the wholesales expansion. That was one of the company's annual target. The growth is quite impressive by any normal standard, but the company had a history of setting higher expectation to an extent that we are not so impressed when we saw the actual number. In previous investor presentation, management set the target of 15,000 distribution points by the year end, when it actually hits 4,551 by Q3. Some investors feel disappointed. Management should learn from this and stop overpromising and under-delivering. As for e-commerce, the company claims the decline was due to reserving inventory for wholesale channel. Retail orders were prioritized and inventory are reserved to support the August US retail launch and fourth quarter e-commerce holiday promotions. If this statement is true and there is no demand decline for e-commerce, then Q3 would be a transitional point and Q4 revenue should explode. The record 1.5 million October revenue has already shown a trend, as the average selling price is $14 per pound for retail and $7 per pound for wholesales. A swift shift of focus from e-commerce to wholesales would naturally hit short-term revenue growth. Now let's look at expenses. The revenue has grown by 85% year-over-year. Yet fulfillment expense has grown by 183%, general and administrative expenses by 275%. As the production ramps up and sales grows, expenses would drop significantly as a percentage of revenue. In hindsight, we might find Q3 the darkest moment before dawn. It is the time when revenue stagnated while expenses drastically went up. That's why share price dropped to 52-week low after the earning. As we know, financial reports are just like camera shots. When you press on the shutter, it leaves you a record of past performance. Investors should rather focus on future growth of the business. The company has not given an outlook for Q4, but if November and December reach the same revenue as October, the revenue growth for Q4 would be 145% year-over-year compared to only 85% year-over-year in Q3. This would make a huge difference on valuation. Let's look at the valuation chart of some of the popular plant-based names. We have year-over-year quarterly revenue growth, current PS ratio and projected PS ratio. PS ratio is the share price we pay for each dollar of revenue generated for trading 12 months. To put it in a simple way, lower PS ratio means better deal for investors. If we ignore dilution and based on current growth rate and market cap, within 3 years, VGFC would have a PS ratio of 2.6. Well, you might say this ratio is not bad at all. But be aware that VGFC is the smallest company of all. There are way more risks involved with VGFC. So the company should have a much higher growth rate to compensate its risk. If we change the ratio to 145, then the ratio would be more interesting at only 1.1 within 3 years. Personally, the growth rate should be around 150% to be considered as a fair trade-off for the valuation and risk. As for director personal loan, the two co-founders have promised to repay the loan within 2 months. This is very likely a compromise under the pressure of recent share price drop following the announcement. I hope management would learn a lesson from this. Now it's time for some questions. Luna would like to know how many distribution points are expected for Q1 2022. Wholesale distribution points are defined as the number of retail stores multiplied by the number of SKUs. Currently, the store count is 805 in Canada. There would certainly be more by next Q1. There would also be at least 1,125 stores in US. So that makes 1,930 stores confirmed in total to date. Each store sells an average of 3.8 SKUs. That translates into 7,334 distribution points. More locations will be confirmed in coming months. Francois would like to know how bad VGFC share dilution is compared to other companies. Here is a chart with dilution rates for trailing 12 months. Be noted, Tattoo Chef has a higher dilution rate due to SPAC merger beginning of this year. Companies usually experience huge dilution if there are lots of venture capital in before public listing. VGFC had no venture capital, so it was less diluted after Nasdaq listing. Balash asked if VGFC has manipulated accounting to show inflated gross profit. VGFC defines gross profit as revenue minus procurement expenses, while most other companies define gross profit as revenue minus cost of goods sold. Purchase, inbound shipping, and production-related costs are included. The only difference is depreciation and amortization are not included in procurement expenses. Outbound distribution costs are not included, but this is a common practice among peers. So yes, the gross profit is inflated. The current gross margin is around 19%. If we compare apple to apple with Beyond Meat, the gross margin should be around 16%. Some companies even include outbound distribution costs as cost of goods sold. For example, Tattoo Chef explained in Jefferies conference that outbound distribution cost is included in the cost of goods sold.
So one of the things that we talked about last night, Rob, is if you were to look at Tattoo Chef, all of our outbound freight, meaning that all of the finished good freight, which includes container costs, it includes freight, is included in our cost of goods sold. And that's an incredibly important thing to hear because I know that amongst our peers, people account for things differently.
Outbound distribution is accounted as fulfillment cost for VGFC. If this is included, VGFC gross margin would be negative 66%. Next question came from Industriel. He asked why stock-based compensation and butcher shop restaurant procurement expenses could be adjusted for gross profit. I believe he's asking about this chart. The company excluded these two items as they think it could better represent the company's ability to generate profit. Stock-based compensation, or SBC, is a way of paying employees with equity in a business. In the case of VGFC, SBC are warranties and options. Let's listen to one of my previous clips about this subject. In conventional IFRS or GAAP accounting practice, SBC is recognized as expense, but in non-GAAP, it is adjusted as share dilution. To further explain this, let's say we have a company ABC, market price at $5 per share. It offers to its employee 100 options to purchase stocks at $4 per share. In conventional accounting, the company loses $1 per share multiplied by 100 shares in SBC expenses. This does not reflect the reality of the business, since the company actually receives $400 in cash while issues 100 new shares. Therefore, its financial position is strengthened at the cost of existing shareholders. It is a common practice for fast-growing companies to represent SBC adjusted margin as its operating margin. Let's look at Palantir Q2 earning. We can see the SBC is added back to its operating losses to better reflect its business. SBC adjusted margin makes sense only when the growth is much higher than dilution. In the case of VGFC, I think it's acceptable to adjust stock-based compensation. About butcher shop restaurant procurement expenses, I think it's not reasonable to exclude it from procurement expenses. Here is why. It is important to understand butcher shop restaurant and the VGFC factory are different business entities. Although they are within the same group, when butcher shop restaurant purchases products from the factory, it is recognized as procurement expenses for butcher shop restaurant and as revenue for the factory. But we are now looking at consolidated financial statements of the VGFC group. You can't just exclude the butcher shop restaurant expenses without adjusting the factory revenue. I strongly recommend some auditing to be done about this misrepresentation. If you have different opinions or questions, please leave comments below and I will try my best to reply. Okay, that's all for today's video. Till next time, bye for now.